Good evening. This is Ken Long from Tortoise Capital with a review of the weekend trading report for March 3rd, 2013. We have a market that is still in bullish normal conditions on an annual basis. Using weekly RSI 14 at 69 out of 100, so right on the boundary of overbought. 10-day status is 74 out of 100 using the 10-day NDX, so at the high end of neutral. The percent stretch relative to the 200-day moving average is green bullish at 8.36%. The slope of the 50-day moving average has rolled over a little bit. It's white bullish at 0.62%. ADX has dropped down to 24.8 as the increased volatility and selling pressure from this week has weakened the bullish trend of the last month. ATR percentage is now up above 1% at 1.01%, moving towards the higher range of normal. The risk index, which is the 30-period moving average of the VIX divided by the 10-period, is now at 0.91, coded red, which is risk-off conditions. And looking back over the last 20 years, a reading of that scale has a z-score of minus 1.23. So again, we're on a risk-off conditions. You can see the time series of that reading in terms of z-score over the last 30 days. You can see the relative volatility increase is reflected in this movement into the risk-off condition. The blended monthly rebalancing portfolios were adjusted this week. The 26 ETF portfolio is holding Australia, U.S. small caps, and Asia less Japan. The 13 ETF is holding. That should be reversed. That should read Australia, financials, and small caps, and then the 13 ETF should read Australia, small caps, and Asia less Japan. The theoretical exposure is at 100%. The model portfolio is also at 100% in ETF2. 4 stops were hit this week in the earlier sell-off on Tuesday. The new positions that are to be purchased Monday morning at the open are Philippines, Thailand, Private Equity Index, and Dow Transports. There's a couple links to a couple good educational videos on trading in the Tortoise style. This is the 13 ETF portfolio. You can see the top 3, and only treasuries are on a sell. And the 26 ETF portfolio, again, it's Australia, financials, and U.S. small caps. Taking a look at the market health check here. The river, the solid blue or the dark blue, 30-period Bollinger Band plus or minus 1 standard deviation. You can see prices hovering just on the northern shore of that river. The lighter blue is the floodplain, which is the 30-period Bollinger Band plus or minus 2. The vertical blue lines are 10, 20, and 30 days worth of look back. The thick black line in the middle is the 30-period regression line. The outer black lines are the channel formed by the greatest diversion from the regression line during the look-back period, which happened here on Tuesday's big sell-off. That's what triggered the sells in ETF2, by the way. You can see that the slope value of the 30-period regression line is rolling over and is starting to flatten out. This is the zero line, this dotted line. If that slope line gets to here, then essentially we would be in a sideways channel of the last 30 days. So you can see how the strength is starting to decay from this long bullish move. The slope now is flatter here than it was in the last pullback period, which healed pretty quickly. So this one looks a little weaker. The purple lines are price targets. The top line at 153 and some change is the swing high achieved late February. Horizontal red lines are support levels that used to be resistance levels in the past. The solid red line here is the 200 period moving average, and then the shaded red area underneath that is the bearish territory for the market. You can see that the strength is coming out of the upward trend here. This is the ADX line that has pulled back from 35 to 25, with bulls only slightly in charge here. Looking at percent R, you can see on this last little move off that bottom has actually been a reasonable short-term trade based on channeling and overreaction signals, which cashed some good trades this week. But the percent price oscillator has rolled over, still pointing downwards now because of the selling pressure of those days and the gap down on Tuesday last week. It's the ETF2 regional report. All 10 of the indexes are on buy signals, so that keeps us at 100% invested, 0% cash. Globals are still stronger than the S&P. Inside the U.S., it's IWM. The small caps, then mid caps, and large caps, and tech. Europe and Asia less Japan are still the two strongest sectors. Two weakest, U.S. tech and Latin America. Tortoise World Market Model. For those of you keeping score at home, I have added the private equity index here into the other asset classes and added a few more Asian countries here: Thailand, Philippines, Indonesia, and Vietnam. You can see the U.S. is pretty much all above average except for the large cap techs. Everything except private equity is suffering here in the other asset classes, except U.S. real estate is doing okay. Asia, less Japan, and Japan are both above average. You can see the key leaders among the Asian countries. A little bit of weakness creeping now into Europe. These come out of the green and now more towards the white. UK remains weak, but mostly Europe is above average. But you can see that the U.S. has caught up. And even in the business sectors, you can see the U.S. starting to dominate here again with materials, energy, finance, staples, utilities are now above their global counterparts. Just a quick review of the top 30 ETFs based on the expanded ETF2 database. Vietnam, Japan, total dividend, Philippines, Thailand, timber, private equity, Dow Transports. The top 30 in the Dow, based on the same kind of lens. Hewlett-Packard remains at the top, having crested above 20. Then three finance companies, J.P. Morgan, Bank of America, Travelers, with 3M and United Tech rounding out the greens. Down on the weaker end, nothing in the Dow is even in the red on relative strength, and so you can see that reflects a shift of money back towards the U.S. and more towards the to large cap stable companies. Merck, United Health, Walmart, Alcoa, and Microsoft, the bottom five. And ETF liquidity just for your reference. We'll shift now to the daily report. See the 30-period regression line. The slope of that is reflected here in the time series. It's still below its 10-period moving average. It has now come back to the 6-month average and slightly under. This dotted line is the zero line. You can see how far it has pulled back in the last 5 days. This is the percent stretch above the 200-day moving average, now resting at the 1 standard deviation above average. Just a sign of weakness. This is looking like a double top kinds of actions. The Z-scores of these symbols based on holding periods of the last X number of days. You'll see the VIX is above average and has done really well on a 10-period basis. Home Depot and S&P Staples doing pretty well. Microsoft actually showing some relative strength compared to its peer group, as is the Dow. These are the Z-scores of 3 different regression lines, the 90 in red, the 30 in black, and the 10 period in blue. And the 90 period regression line still holding the upper band here of the +1 standard deviation. So as long as it stays above the lower Bollinger Band channel that you see here, it should be, it's still a positive trend. Really, with support at about 145, this would longer term just be looked at as a buy on dip opportunity. But you can see the strength of the 30 coming out. The 10 has bounced and started to roll back up based on the last 3 or 4 days. So this is really a chance for it to make a run at 153 and then continue maybe a third leg. If you count this as 1 leg up, 2 legs up, a third leg could take it to 158-ish or almost 160. If the previous leg ups are any indication, it would take something like a resolution of the sequester to get good news stories back in the news, I would think. And just our standard reference charts. These are looking at the TV ratio. Essentially is the average range percentage of the last 30 days multiplied by its frog quality number. Gives you this trading value ratio, or TV ratio. So if you sort by that trading value ratio, you get a combination of the frog quality number, which is reliability, plus absolute value of what it's trading intraday. That will give you a balanced sense of excellent trading candidates. So something like AT&T has a relatively low intraday percentage, but has such a high frog quality number that it moves closer to the top. The VIX, because its volatility is so all over the map, it has a low frog quality number. However, its range percentage is so high that when you take that into account, it's a pretty good intraday trading target. So that's how you use this chart. We'll throw the fail stat up here, and again, I'm going to cycle through these reference charts for you without much comment. This is one we should pay attention to because the transports are extremely strong. They're a top 10 ETF globally right now. So if we're looking for relative strength to reward, we want to be looking for things that have a high 30-day quality score. Matson, Kansas City Southern, and Kirby Corporation. Longer term, the strength is in J.B. Hunt, Alaska Air, Union Pacific, and Kansas City Southern. So Kansas City Southern looks like something I should be paying attention to since I live here in Kansas City. What? Some research to do. Pivots and the daily safe zone. All right, so it's still a bullish, strong market that has pulled back enough to give some buy on dip opportunities, but has pulled back far enough also that we want to be sensitive to locking in profits and protecting positions that are already on the long side. This is Ken Long from Tortoise Capital. Thanks for your attention. Keep your powder dry and your risk measured.